What if I told you that gold is not rising because of inflation, but because the world may be moving toward a dangerous financial reset? What if central banks already know something most people still ignore? Right now, nations are quietly buying gold at record levels. Investors are shifting wealth across borders, and fears of debt defaults are growing stronger. This may be one of the most important moments for gold and silver investors in modern history. Welcome to Gold Silver Scope. Most people are taught one simple story: when inflation rises, gold rises. But the truth is much deeper than that. Gold often moves higher when trust begins to disappear. Trust in governments, trust in currencies, trust in debt markets, trust in global stability. And when that trust weakens, smart money starts preparing early. Today, many countries hold massive amounts of U.S. debt in their reserves. For years, that debt was considered one of the safest assets in the world. But now a new fear is entering the system. What happens if major powers move into direct conflict? What happens if geopolitics becomes more important than financial promises? In extreme situations, history shows governments protect themselves first. Debt obligations can be delayed, restructured, frozen, or ignored. That is why many central banks are increasing gold reserves. Gold is different from paper promises. It does not depend on another country paying you back. It is neutral. It carries no political flag. It cannot be sanctioned in the same way as digital systems or sovereign bonds. That is why gold is becoming more attractive in a divided world. And this is not theory. History gives us warnings. During the early 1930s, sovereign defaults spread across nations. Countries failed to meet obligations. Financial panic increased. Thousands of banks collapsed in the United States. Ordinary families who believed their savings were safe suddenly found themselves trapped. Many people held foreign government bonds that became worthless. Once confidence cracked, panic moved quickly. This is why serious investors always study history. Financial systems often look strong right before they become unstable. Now look at today's environment. Global debt is at extreme levels. Trade tensions continue. Military tensions are rising. Political alliances are shifting. Nations are rethinking where they store reserves. And one of the clearest signals is this: gold demand from central banks remains strong. That means governments themselves are hedging risk. When central banks buy gold, they are not chasing headlines. They are planning years ahead. They are asking hard questions. What if currencies weaken? What if sanctions expand? What if debt markets face stress? What if global trust declines? Gold becomes the answer when uncertainty grows. Another major factor many people miss is the movement of physical gold. In uncertain times, institutions often want direct control over their metal. They do not just want paper exposure. They want real bars stored in trusted vaults, sometimes moved closer to strategic locations. This behavior increases when investors fear capital controls, banking restrictions, or market shutdowns. That may sound extreme, but history shows it happens during wartime and crisis periods. Governments can freeze markets. Banks can limit withdrawals. Cross-border transfers can slow down. When that happens, owning assets inside the system may not feel as safe as before. Gold stands apart because it can function outside many financial channels. And let's not forget silver. Silver often follows gold in the early stages of fear-driven rallies, but later it can move much faster. Why? Because silver is both a monetary metal and an industrial metal. It benefits from investment demand and supply shortages. If gold starts signaling financial stress, silver can become explosive. That is why many experienced investors watch the gold-to-silver ratio closely. When gold rises first and silver lags, it can sometimes create opportunity. Right now, the average person still thinks gold is boring. They think stocks are the only path. They think central banks know less than social media influencers. But history repeatedly shows that by the time everyone notices gold, much of the move has already happened. The smart money usually moves quietly. This moment may not be about inflation at all. It may be about confidence. And confidence, once broken, is hard to restore. So ask yourself one question. Why are central banks buying gold now, if everything is supposedly fine? Because gold is not bought for comfort. It is bought for protection. And if the world enters a more unstable chapter, gold and silver may stop being optional assets and become essential assets. What if the next gold rally is not caused by inflation, but by war, trade conflict, and the collapse of global trust? Most investors are watching interest rates, CPI numbers, and stock markets. But they may be ignoring the biggest force of all, geopolitical risk. And when geopolitical risk rises, gold often reacts faster than the headlines. The world economy was built on cooperation, open trade, and trust between nations. Goods moved across borders. Money moved through shared banking systems. Countries bought each other's debt. This created decades of growth, but now cracks are appearing in that structure. Tariffs are one major warning sign. Many people think tariffs only affect one product or one company, but broad tariffs can impact entire supply chains. Prices rise, trade slows, and countries begin retaliating. What starts as economic policy can quickly become political confrontation. Once that happens, markets become unstable. When nations stop trusting each other economically, they start preparing strategically. That means building local industries, securing resources, increasing military spending, and reducing dependence on foreign systems. This process is already happening across the world. Countries are becoming more defensive. They want control over energy, metals, food supply, technology, and payment systems. And that is where gold enters again. Gold thrives when the world becomes fragmented. It performs strongly when investors fear that the old global system is weakening. It benefits when countries want neutral reserves outside political influence. Now think about what happened when financial systems were used as weapons. When countries are removed from major payment networks or threatened with sanctions, every other nation takes notice. Even allies begin asking a quiet question. What if one day this is used against us too? That question changes behavior. Instead of relying fully on one system, countries diversify. They create alternative settlement channels. They trade in local currencies. They increase gold reserves. They seek financial independence. This is not anti-dollar behavior alone. It is risk management. The US dollar remains powerful because America still has one of the largest consumer economies in the world. Global companies still want access to that market. But power can remain strong while trust slowly changes. Those two things can happen at the same time. That is why gold can rise even while the dollar remains important. Many investors misunderstand this relationship. They think gold only wins if the dollar collapses. Not true. Gold can rise simply because uncertainty rises. Gold can rise because countries diversify. Gold can rise because debt concerns increase. Gold can rise because the world becomes less predictable. And then there is Europe. Whenever regional tensions rise, capital looks for safety. Investors often move money toward markets viewed as more stable or liquid. If concerns grow around war, political stress, energy shortages, or financial controls, gold demand can increase sharply. History supports this. During major conflicts in the 20th century, financial power shifted dramatically. Gold moved toward stronger, safer jurisdictions. Nations that entered war often faced market closures, restrictions, shortages, and damaged currencies. Those holding portable hard assets had more flexibility. Today, even the fear of such outcomes can move markets before events happen. Gold is forward-looking. It does not wait for full crisis confirmation. It often begins rising when the first serious doubts appear. By the time panic is visible on television, gold may already be much higher. Now let's talk silver. Silver tends to stay quiet longer than gold. It can frustrate investors. But when momentum finally arrives, silver often accelerates because the market is smaller and supply tighter. It is also heavily used in electronics, solar energy, industrial manufacturing, and strategic sectors. So if geopolitical tension disrupts mining supply chains while investment demand rises, silver can move in powerful waves. That combination is why many long-term investors accumulate silver during quiet periods. Another hidden factor is base metals shortages during conflict cycles. War economies consume copper, nickel, steel, aluminum, and industrial materials. Supply chains get redirected. Governments prioritize strategic needs. This can create broader commodity inflation, which often helps precious metals sentiment too. So while many investors stare only at stock charts, a bigger story may be unfolding underneath. Trade blocs forming, global alliances shifting, debt stress rising, strategic resource competition growing, nations buying gold, investors seeking protection. This is how major cycles begin. Gold does not need the world to collapse. It only needs the world to become less certain. And right now, certainty is disappearing fast. What if the real reason gold could explode higher has nothing to do with inflation, interest rates, or even war alone? What if the biggest driver is something far more powerful, the loss of confidence in governments and financial systems? Because once trust starts breaking, money moves fast, and when confidence falls, gold and silver often become the first place serious investors run. Most people think markets move only because of data. They believe prices react to reports, speeches, and numbers on a screen. But behind every market is psychology. People buy when they feel secure, they sell when they feel uncertain, they protect wealth when they stop believing the system will hold. That is why confidence matters more than headlines. History gives us clear examples. Gold has gone through long periods where inflation was rising, debt was rising, and yet gold stayed weak. Then suddenly, during moments of fear or geopolitical shock, gold surged rapidly. Why? Because inflation alone does not create panic. Loss of trust does. When people begin questioning central banks, governments, debt repayment, banking stability, or political leadership, gold changes from an optional investment into financial insurance. And today, trust is being tested everywhere. People see rising debt with no clear solution. They see political division growing. They see conflicts expanding. They see banking stress appear suddenly and then disappear from the news. They see currencies losing purchasing power year after year. They see systems that look stable on the surface, but feel fragile underneath. This is exactly the environment where gold becomes important. Gold does not need permission. It does not rely on earnings reports. It does not depend on promises from politicians. It has survived wars, defaults, recessions, currency resets, and banking collapses for thousands of years. Silver offers a different opportunity. Silver is often more volatile, meaning it can fall harder and rise faster. It is smaller than gold in market size, which means new demand can move price aggressively. It also has industrial demand from solar panels, electronics, medical technology, and manufacturing. So silver can benefit from both fear and growth trends. That dual role makes silver one of the most interesting assets during uncertain times. Now ask yourself this question. If governments and central banks are increasing gold exposure, why are ordinary people still waiting for media approval? Usually, by the time mainstream headlines say gold is a great buy, the early move is already gone. Smart investors position before the crowd. They study cycles. They understand that markets reward preparation, not reaction. This does not mean putting everything into gold or silver. It means understanding why these assets matter in a world of debt, instability, and declining trust. It means using them as part of a balanced strategy. Even a small allocation can act as protection when other assets struggle. And remember this, gold's biggest rallies often happen when people least expect them. They begin quietly, then momentum builds, then fear joins, then the crowd arrives late. Could that cycle be starting again? No one knows exact timing. But the ingredients are visible: massive debt, geopolitical tension, trade conflict, reserve diversification, central bank buying, fragile confidence. That combination should not be ignored. For gold and silver investors, patience is often the hardest skill. These metals can stay quiet for long periods, but when the world changes, they can reprice very quickly. That is why many long-term investors use slow accumulation instead of emotional chasing. They build positions during calm periods and wait while others sleep on the sector. The next chapter in precious metals may not be driven by hype. It may be driven by necessity. If you enjoyed this breakdown and want more deep analysis on gold, silver, market risks, and wealth protection, subscribe now to Gold Silver Scope and stay ahead of the crowd before the next big move begins.